Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. After a brief spell of inflation-induced uncertainty, the market has calmed down somewhat. A speech by the Fed chairman decidedly quelled investor worry. In his testimony to the Select Subcommittee on the Coronavirus Crisis, the Fed Chair Powell assessed that inflation is expected to drop back toward our longer-run goal. More importantly, he affirmed that the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. This means no drastic change and no premature tightening of the accommodative monetary policy. A quick glance at the CRB index, an index comprising of 19 commodities, shows that its upward momentum is slowing. Inflation may slow later this year. As fears abated, U.S. stocks immediately hit new highs. In last week's commentary, we noted that tech stocks were resilient during the setback. Not surprisingly, the sector was first to rebound. The Nasdaq 100 index was in uncharted waters throughout the week. Meanwhile, the S&P 500 index also touched new highs. While all these developments are bullish, what caught our attention was China, the second largest stock market in the world. The equity market there has been developing some up moves of late, under the radar of most news outlets. Look at the Chinese CSI 300 index, the equivalent of the S&P 500 in the U.S. It is a capitalization-weighted index of the largest 300 stocks in the Shanghai and Shenzhen stock markets. The index peaked near the psychological 6,000 in February this year, and after a period of consolidation, the index rebounded last week with the potential to reaffirm its long-term uptrend. The pattern of rising lows on its chart suggests investor accumulation. Yes, we all know the Chinese story, but why China now? If the world stock market is rising, wouldn't it be better to buy U.S. stocks which are making new highs? That's true, but China offers some complementary bets on new and huge markets. The country weathered the COVID-19 pandemic relatively well in 2020. Its growth this year could be equally good. As a preview of what is to come, China's first quarter GDP growth was 18%. The second reason for investing there is that new Chinese tech companies could offer appealing long-term returns. Surely you've heard of Alibaba, up 4 times from its $65 low. Another great stock, Tencent, rose 30 times more than it has in a decade during 2021. Pinduoduo managed a 10 times return in under 18 months. Warren Buffett once made a $3.5 billion profit on PetroChina in just 4 years, and his bet on BYD is currently up 25 times. Played right, you can reap a fortune from China's massive growth. Furthermore, China's currency may appreciate against the U.S. in the long term, which gives another boost to investor return. Of course, the bears will point out that doing business in China is fraught with risk. True. Even the largest companies have had their wings clipped recently. For example, Alibaba's Ant Group $37 billion IPO was called off at the last minute, an event that sparked a series of policy changes, including a $2.8 billion anti-monopoly fine for the company. Moreover, there is so much accounting risk associated with Chinese stocks. The boom and bust of Chinese reverse mergers is a cautionary tale, and regulatory changes in the country can be quite sudden. This makes Chinese stock quite volatile. Lastly, there's a lot of embedded credit risk in the Chinese property market. Against this backdrop, should you still invest in China? Yes is the short answer. Avoiding them is like avoiding Japanese stocks in the 70s and 80s. To mitigate against single stock risk, investors should consider buying an ETF because they are more diversified. One of the largest Chinese ETFs in the U.S. is iShares MSCI China, a $7.3 billion fund with exposure to large and mid-sized Chinese companies. The fund tracking the CSI 300 index is the X-Trackers Harvest CSI 300 China A shares. Crane Shares China ETF is a more volatile fund because it specializes in Chinese tech stocks. If you are more geared towards higher risk, investing in some of the Chinese shares with strong technical action may be more fruitful. One example is Bilibili. Given the volatility of stock prices, stop losses are recommended. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.